To understand why the silver market is on the verge of a historic fracture, we must first pull back the curtain on the grand illusion of Western price discovery. When you look at the ticker on your screen showing the price of silver, you aren't looking at the value of a physical metal. You are looking at the trading price of a promise. This is the world of the Commodity Exchange in New York and the London Bullion Market Association. These institutions operate on a system that is essentially fractional reserve banking, but for metal. Let's break down the inventory reports that the big banks use to soothe the public. They divide silver into two categories, eligible and registered. This distinction is the first layer of the deception. Eligible silver is simply metal sitting in a vault that meets the exchange's requirements for purity and weight. However, it is not for sale. It belongs to private individuals, exchange-traded funds, or institutions who are simply paying for storage. Registered silver, on the other hand, is the metal actually tagged and available for delivery to settle a futures contract. The deception lies in the fact that the financial media often aggregates these two numbers to make the silver supply look massive. In reality, the registered category, the only silver that actually matters for price discovery, is a tiny fraction of the total. And it is shrinking every single day as the East drains the vaults. This leads us to the most staggering mathematical absurdity in modern finance, the paper-to-physical leverage ratio. In an honest market, for every contract sold, there should be an ounce of silver waiting in a vault. But in the Western paper markets, the ratio of paper claims to actual physical ounces is estimated to be as high as 400 to 1. Imagine a game of musical chairs where there are 400 people circling a single chair. As long as the music keeps playing, everyone feels like they have a seat. The music, in this case, is the rolling over of paper contracts. The banks manage this through two predatory concepts, hypothecation and rehypothecation. Hypothecation is when a bank uses your silver as collateral for their own trades. Rehypothecation is when they take that same collateral and pledge it again to a third party, and then a fourth, and then a fifth. It is a tower of digital promises built on a single physical foundation. This creates a massive artificial supply. By selling hundreds of digital ounces that do not exist, the big bullion banks can crush the price whenever they want. Because on a computer screen, silver appears to be infinite. But what happens when someone actually wants their metal? This is where the cash settlement loopholes come into play. The system is rigged to prevent physical delivery at all costs. The primary mechanism is called exchange for physical. This allows big institutional shorts to settle their delivery obligations off the exchange, away from public eyes, often by paying the buyer a premium to take cash instead of the metal. If you are a large trader and you demand your silver, the exchange has the right to force a cash settlement on you if they deem there is a market emergency. They don't give you the silver, they give you a check for what the suppressed paper price says the silver is worth. This effectively severs the link between the digital price and the physical reality of the earth. So, why does this complex web of deception exist? It isn't an accident. The goal of the paper market is to provide what economists call infinite liquidity. By decoupling the price from the physical constraints of mining and refining, the banks can suppress volatility. If silver were allowed to trade based on its true scarcity, the price would be too volatile and too high for industrial users and central banks to manage. The paper market creates a permanent illusion of abundant supply, keeping the price low and the masses disinterested. But the Shanghai Gold Exchange has stopped playing this game. The East is now calling the West's bluff, and the 400 people circling that single chair are about to realize the music has finally stopped. While Western markets perfected paper suppression, a massive paradigm shift has been quietly taking place in the East. To understand why the paper market is about to break, look at the Shanghai Gold and Futures exchanges. In the West, silver is a high-speed financial derivative, a line on a screen to hedge against interest rates or the dollar. But in China, silver is a strategic necessity. This difference created a dual-track pricing system tearing the global market apart. The most critical distinction is physical delivery. Nearly 95% of COMEX transactions are settled in cash. In contrast, the Shanghai Gold Exchange is built on load-in and load-out. If you buy silver, the exchange assumes you want the metal. The settlement cycle is incredibly fast, often between 0 and 2 business days, and the metal moves physically. No infinite rollovers or easy cash settlement escape hatches for short sellers. This creates an honest price discovery mechanism. This brings us to the phenomenon rocking the financial world, the Shanghai Premium. For much of 2026, silver in Shanghai traded at a staggering 12 to 15% premium over the Western spot price. In an efficient market, this gap should close in minutes by arbitrage. But the gap isn't closing, it is widening. This is the market's way of screaming that there is a physical shortage, not enough metal in the West to ship east. Why is China so hungry for silver? It's a combination of massive industrial demand and a coordinated sovereign strategy. China is the world leader in solar photovoltaic production, an industry that consumed over 100 million ounces of silver last year. As the world pushes for green energy, China realized silver is the new oil. They are stockpiling for the next decade. AI infrastructure adds pressure. Every high-end semiconductor and data center server requires silver for its conductivity. The Chinese government views silver as a Tier 1 strategic resource, willing to pay a premium for raw materials. But there's a deeper, more systemic motivation: the BRICS master plan for de-dollarization. China, Russia, India, Brazil, and South Africa are actively building an alternative financial architecture. They move away from a world where the US dollar and Western banks dictate commodity prices through paper manipulation. By establishing Shanghai as the primary hub for physical metal, they are effectively hijacking the price discovery process. If the world wants physical silver, they increasingly look to the East, where the price is much higher than digital fiction. Finally, we are seeing the emergence of backwardation in the Shanghai markets. Every investor must understand this technical term. Normally, future silver costs more than today's due to storage. In backwardation, immediate delivery is higher than future price. It's a sign of extreme desperation. Buyers pay a massive scarcity premium to get the metal right now. This isn't just a trend, it's a structural fracture in the global monetary system. The East is simply taking control. The divergence between the East and the West is not just a statistical curiosity. It has created a massive magnetic force that is physically pulling silver out of London and New York and depositing it into the vaults of Shanghai. This is the great arbitrage drain, and it is the mechanism that will eventually break the back of the paper market. To understand how this works, you have to think like a high-level institutional trader. If you can buy an ounce of silver for $76 in New York and sell it for $88 in Shanghai, you have a $12 spread. Even after subtracting costs for transport, insurance, and duties, you are looking at a massive risk-free profit. In a normal liquid market, this arbitrage would happen instantly and the price gap would vanish. But we are not in a normal market. The gap isn't closing because the physical supply in the West is hitting a wall. We are witnessing what experts call an arbitrage under acute stress. Large-scale traders are no longer just shuffling paper contracts. They are standing for physical delivery, taking the metal from Western exchanges and putting it on planes to Asia. The numbers are staggering. In the first 2 months of 2026, China's imports of unwrought silver surged by nearly 6,000% compared to the previous year. This is a vacuum cleaning out the Western world's remaining reserves. Look at the inventory levels of the major Western hubs. The London Bullion Market Association and the Commodity Exchange are reporting massive single-day withdrawals. In 1 week alone, in early 2026, over 18 million ounces of silver vanished from the commodity exchange vaults. Total registered silver has plummeted by 30% since the start of the year, dropping below the critical 85 million ounce threshold. This is a historic drain. The West is losing its physical ammunition, and the bullion banks are starting to realize they cannot print more physical silver. But there is a hidden bottleneck that is accelerating this crisis: the refining capacity. Most of the silver held in Western vaults is stored in 1,000-ounce good delivery bars. These are massive, heavy blocks for institutional storage. However, the high-demand markets in China and India prefer kilogram bars, or smaller formats for industrial paste and retail investment. Refineries are currently slammed with a massive backlog as they scramble to melt down those 1,000-ounce bars and recast them into the smaller sizes the East demands. These refining bottlenecks are creating a massive lag time in the arbitrage loop. Even if there is silver in London, it cannot reach the Shanghai market fast enough to satisfy the hunger of the Chinese solar and electronics industries. As this physical drain continues, the Western exchanges are being forced into a corner. They are increasingly relying on exchange for physical maneuvers to hide the extent of the shortage. They are essentially begging large traders to take a cash bonus instead of the metal, just to keep the vault doors from swinging open and revealing an empty room. But the arbitrageurs aren't interested in paper bonuses anymore. They see the writing on the wall. They know that a physical ounce in a Chinese vault is worth far more than a digital promise in a New York computer. This is the ultimate trap for the short sellers. If they allow the Western price to rise to meet the Shanghai price, they face a catastrophic loss. But if they keep the Western price artificially low through paper manipulation, they only make the arbitrage more profitable, which accelerates the physical drain. Every day the price is suppressed in New York is another day that a few million more ounces are loaded onto a plane headed for Shanghai. The system is cannibalizing itself. The West is subsidizing the East's accumulation of the world's most important industrial metal. We are approaching a moment where the registered inventory will hit a level so low that the exchange will be forced to halt trading. When that day comes, the paper deception ends and the physical reality begins. We have reached the endgame, the convergence of a 6-year structural deficit, massive industrial demand from AI and solar sectors, and the relentless physical drain from west to east has brought us to a singular tipping point. Historically, when a market is this tightly coiled, it doesn't just bend, it breaks. To understand how this break will manifest, we only need to look at the recent volatility of March 2026. We saw the commodity exchange house account forced to absorb over 80% of delivery notices in a single session. This is an unprecedented move that signals the lender of last resort for silver is already stepping in to prevent a total systemic collapse. What happens next is a phenomenon known as a force majeure event. On paper-heavy exchanges, clauses allow them to halt trading or settle contracts in cash if they determine that a physical delivery is impossible. We saw a preview of this with the nickel market a few years ago. When short sellers are trapped and the metal is gone, the exchange changes rules to save banks. If you hold paper silver, you'll likely get a check for $60 or $70 an ounce, while physical metal trades for over $150 in the private market. This settlement risk is why the world's smartest money is currently fleeing the digital system. The breaking point will likely be triggered by a delivery default. Imagine a major sovereign entity or a massive industrial manufacturer standing for delivery of 20 million ounces. If the exchange cannot find that metal in its registered category, liquidity instantly evaporates. This would trigger a cascading short squeeze. Short sellers, faced with infinite losses, would be forced to buy back their positions at any price. But with no physical metal available to sell, the bid-ask spread would widen to hundreds of dollars. This isn't just a price hike. It is a total regime change in how the world values hard assets. As we wrap up this deep dive, the conclusion is inescapable. The Shanghai premium was never just a temporary glitch. It was the first crack in a dam that is now bursting. We are moving from a world where price was determined by mouse clicks in London and New York to a world where price is determined by the weight of a bar in Shanghai and Mumbai. The era of paper-driven price discovery is dying. In its place, we are seeing the birth of a physical first market, where silver is recognized as a strategic, high-tech mineral essential for modern civilization. For the investor, the lesson of 2026 is clear. The massive disconnect between the $80 paper price and the physical reality of the earth is a gift that will not last forever. Once the paper market breaks and the force majeure notices are sent out, the window to acquire physical metal at these suppressed levels will be permanently closed. We are witnessing the final days of a century-long deception. The East has called the bluff. The vaults are being emptied, and the true value of silver is about to be realized. Thank you for joining me for this advanced analysis. If you found this breakdown of the Shanghai Western arbitrage loop valuable, make sure to hit the like button and subscribe for our next deep dive into the global liquidity reset. I want to hear from you in the comments. Do you think the Western exchanges will survive the March delivery cycle? Or are we weeks away from a total trading halt? This is a fast-moving story, and we will be here to track every ounce that leaves the vault. Until next time, keep a close eye on the physical premiums, and remember, in a world of infinite paper, only the physical is real.